Like and subscribe and click the bell icon to get new video updates.
As set to fall as Wall Street slides on Fed Minutes by Damian Troyes and Alex Feig, April 7, 2022, 5.29 am. Save login, register or subscribe to save articles for later. Share normal text size, larger text size, very large text size. Stocks closed lower and bond yields rose on Wall Street on Wednesday after details from last month's meeting of Federal Reserve policymakers showed the central bank intends to be aggressive in its efforts to fight inflation. The S&P 500 fell 1%, adding to its losses from a day earlier. The Dow Jones Industrial Average dropped 0.4% and the Nasdaq slid 2.2%. The Australian share market is set to open lower, with futures at 6.59 am, pointing to a fall of 21 points, or 0.3%, at the open. Wall Street moved higher after the release of the Fed minutes before sliding. Credit, AP. The minutes from the meeting 3 weeks ago revealed that Fed policymakers agreed to begin cutting the central bank's stockpile of treasuries and mortgage-backed securities by about $95 billion, $126 billion, a month, starting in May. That's more than some investors expected and nearly double the pace the last time the Fed shrank its balance sheet. At the meeting, the Fed raised its benchmark short-term rate by a 0.25 percentage point, the first increase in 3 years. The minutes showed many Fed officials wanted to hike rates by an even bigger margin last month, and they still saw one or more such supersized increases potentially coming at future meetings. Essentially, the Fed has concluded that a good offense is the best defense, said Sam Stovall, chief investment strategist at CFRA. We're likely to experience not only higher short-term interest rates as a result of the Fed's actions, but also higher long-term rates, which should pressure potential stock gains. Higher rates tend to reduce the price-to-earnings ratio of stocks, a key valuation barometer. Such a scenario can particularly hurt stocks that are seen as the priciest, which includes big technology companies. That explains why tech stocks were the biggest drag on the benchmark S&P 500 Wednesday. Apple fell 1.8% and Microsoft shed 3.7%. Communications companies, retailers and others that rely on direct consumer spending also weighed heavily on the index. Amazon fell 3.2% and Facebook parent Meta fell 3.7%. The S&P 500 ended down 43.97 points to 4,481.15. The Dow slid 144.67 points to 34,496.51, and the tech-heavy Nasdaq lost 315.35 points to 13,888.82. Smaller company stocks also fell, sending the Russell 2000 index down 29.11 points, or 1.4%, to 2016.94. Investors are keenly focused on Fed policy as the central bank moves to reverse low interest rates and the extraordinary support it began providing for the economy 2 years ago when the pandemic knocked the economy into a recession. The Fed's proposed timetable for allowing billions in bonds and mortgage-backed securities to roll off its balance sheet was hinted at on Tuesday in remarks by Fed Governor Lael Brainard, who said the process could start as soon as May and proceed at a rapid pace. The rapid reduction in the Fed's balance sheet would help push up longer-term rates, but also contribute to higher borrowing costs for consumers and businesses. The reality is we are in uncharted waters here and the Fed has a difficult task in unwinding the tremendous monetary support over the past couple years, said Charlie Ripley, senior investment strategist at Allianz Investment Management. Against this backdrop, it is highly conceivable that uncertainty in the path of monetary policy will remain embedded in markets, and that is exactly what we have been witnessing with the recent moves in interest rates and risk assets. The yield on the 10-year Treasury rose to 2.61% after the release of the minutes. It had been at 2.59% earlier in the day, up from 2.54% late Tuesday. The yield, which is used to set interest rates on mortgages and many other kinds of loans, is the highest it's been in 3 years. Traders are now pricing in a nearly 77% probability the Fed will raise its key overnight rate by 0.5 percentage point at its next meeting in May. That's double the usual amount, and something the Fed hasn't done since 2000. Even though we've known about the coming rate hikes, it's been pretty difficult for long-term equity managers across the board, said William Houston, Chief Investment Officer at Bay Street Capital Holdings. Inflation is running at a 4-decade high and threatens to crimp economic growth. Higher prices on everything from food to clothing have raised concerns that consumers will eventually pull back on spending. Russia's invasion of Ukraine has added to those worries, pushing energy and commodity prices, including wheat, even higher. U.S. benchmark crude oil prices fell 5.6%